Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of hosting Yonah Weiss, folks who are connected within various real estate circles. Yonah is a very helpful and a very familiar figure. Welcome to the show, Yonah.
Thank you so much, Sakar. It's a pleasure to be on here. I appreciate you having me.
Awesome. Thank you. So Yonah is with Madison SPECS. He is a specialist in doing cost segregations, and you know what, the benefit that comes with cost segregation for a lot of investors. So we are going to talk about the process. Over the years, Yonah has saved tens of millions of dollars to all the real estate investors via his company, Madison SPECS. He is a real estate investor himself, and he has a new podcast by himself that we are excited to learn about. The podcast is named Weiss Advice. So welcome to the show, Yonah. I appreciate you taking time today.
Again, it's the pleasure is all mine, Sakar.
Good. Awesome. So give us a quick background, Yonah, as to, sort of how you came about in real estate and how cost segregation became a sort of a profession and a passion of yours.
It has become a passion of mine. My background is in teaching. So I was a teacher for about 15 years, and it still is. It's really my passion is teaching more than anything else. Not necessarily school teaching. Okay. I didn't really teach a lot of like young school children. It was more about just the ability to, when you learn something, you can give it over and you can teach someone else. You can apply that. But about 5 years ago, I kind of got the real estate bug, if you will, and I wanted to learn all about it, started getting involved. It was, kind of sunk my, tiptoed into a lot of different areas, got my feet wet in the residential side of brokering properties, looking at deals, underwriting. I did a little commercial mortgaging. So that kind of gave me a lot of base knowledge about commercial real estate. And then did a few fix and flips up in New Jersey. And that gave me some knowledge about what not to do. Right?
And the real world side of it.
the real deal, right? And at a certain point, I just had an opportunity come my way to work with this incredible company, Madison Commercial Real Estate, that I currently work for. So they have a number of services for the commercial real estate industry, a big title company, big 1031 exchange, intermediary, and you do a number of things. And Cost Segregation was one of the companies. And it just so happened what I was looking for just kind of slipped right into what they were looking for. And I continued just, kind of learn the trade really quickly. I don't do any of the, we have a whole team of engineers and accountants that do the actual work. So I'm in the business business development, working on kind of teaching people, educating people about that. Bringing in business. So that to me has been extremely eye-opening because, I learned from the experts. Like literally these people have been in the industry for decades and have done tens of thousands of cost segregations. And for me, that's the best way to learn. If you want to learn something new, you go to the best people out there and you just like sit by their side for as long as you can and just, ask them every question you have and just watch what they do. And if you're a good student like I am, you can then go ahead and teach that to others.
Absolutely. Thank you for sharing that. And as we got started and we were talking in the green room, first time when I heard of cost seg and how you can depreciate things, I was like, really, is that really possible? I mean, that sounds just too good to be true. So let's get rolling here, Yonah. Describe for our listeners what the process of cost seg is and why it is such an important element of what we do within real estate, and why IRS in general allows for all of these things, and what's kind of the basis of all of this, you know?
It's something so interesting because we come from the world, the corporate world, where we think that if you make money, you have to pay taxes because it gets directly deducted from your paycheck, right?
Sure.
But in real estate, it doesn't work like that. In real estate, as you know, you make money, okay? You have expenses and you have, profits, and you have net operating income after all those expenses.
Sure.
Whatever is left, you report in your tax form, and if you owe any taxes on that, you pay the tax bill, but it's not deducted immediately. The best thing about it is that you get a tax deduction called depreciation.
Sure.
Okay? And so that's, to understand cost segregation, we have to understand what depreciation is.
Absolutely.
Because cost segregation is really just like, depreciation on steroids. Is like,
exactly. Accelerated depreciation of sorts. So give us a rundown of how you break it down, the building, land, and all the different sort of components within the structures and things like that. Give us a sort of a brief overview of it.
Absolutely. So cost segregation, like I said, is like an advanced form of depreciation. Normally, when you buy a property, you're allowed to write off the entire building, the entire property, minus the land. Land doesn't depreciate. You take that purchase price and you divide it up over a 27.5-year period.
Sure.
Okay. But really that 27.5-year period is, according to the tax code, only supposed to be allocated to the structure of the building. But a lot of other things in the building depreciate on a much faster rate. So you have stuff in the building like personal property, whether it's furniture or equipment, appliances, carpeting, blinds, like you see in the window there, the window treatments, electrical, all kinds of things that are not part of the structure. They're not really physically attached, but even things like cabinets or countertops, which are attached, but they're still movable if you can take them out. Those are all considered 5-year depreciation schedules, which means the possibility of hiring a cost segregation company, an engineer will actually come to the building, identify all of those different assets in the property and know to allocate them into these different categories and say, the walls and the floor and the roof, and the windows and the doors, that those things are not movable. They're integral structural components of the building. That has a value of X. Okay.
Right.
All those other things, each one has an individual value. We'll complete a report for it and tell you, guess what? You spend $1 million on this building. 20% of that, potentially is really in those furniture and fixtures and movable property, personal property. You can take that 20%, $200,000 as a first year or over 5-year tax write-off.
I see.
Now, essentially, that's how you do it.
Right. Now, what's the sort of the basis for this, the cost basis? Like, are we saying, okay, like if we take an example of any random building for that matter, right? The carpeting, the appliances, or, a lot of other personal property, like how are we valuing it? Meaning, is there any black book that engineers use, or is it more based on whatever the owner can show the receipt saying, okay, my appliances cost me this much, my carpet costs me this much, and things like that? How does that work?
Well, it's a good question, because when you develop a property and you're building it from scratch, you know exactly what those costs are.
Okay.
And if you bought new appliances, you know exactly, like you said, you have those receipts.
Sure.
You have the invoices of that property. But on a cost segregation, you can do it on an acquisition, which means the engineers actually have to come in and reverse engineer the property. And they have industry standard values and regional standard values for every type of asset class. And there's literally, you wouldn't even believe it, but for example, asphalt and concrete and pavement, okay, all that stuff is considered land improvements and depreciates on a 15-year schedule. But each of those things actually have a different value. And the curbing, it's still concrete, but it has a different value, an industry standard value, than the pavement that you pave. And so do the bollards, that are in the parking spaces. So all of those things you need to know, what's the square footage, and that's what the engineers do. So there is some, they have some software, they have some, standards that they use, and we'll apply those to come up with those values.
Interesting. Very interesting. Now, Yonah, speaking of this, right? What sort of savings are involved, like in your experience? Give us some examples, like, just knowing you and your company, what you all guys do. I have heard of certain things and stuff like that. If you can give us some real world examples of some, like, let's say single family plus some multifamily, that'd be great.
Absolutely. And I mentioned before, there's, usually a percentage. So different types of property, every type of property is going to be different. Which is why the engineer needs to actually go there and, view it, take pictures, measurements, to make sure that each property gets its proper, it's not like just kind of a throw the dart at the wall and come up with these numbers. You actually have to know exactly every detail, down to the nuts and bolts, really. So just a really good example and kind of a rubric, if you will, to understand this. Multifamily properties, the garden style multifamily property, usually have somewhere between, on average around 20% that will go into that 5-year category. Okay. Sometimes, between 15 and 25, I would say, depending on that, but I'd say 20% is pretty average. And then the land improvements, which I mentioned, are things like landscaping and pavement. And if you have, playground equipment or swimming pool or fencing, anything outside of the building, that's usually like about a 5 to 15% as well. So we're talking about multifamily properties, it's anywhere between, 20 and 35, 40%.
Wow.
When you're talking about $1 million purchase price, you're looking at a accelerated depreciation of, $150 to $250,000, $300,000, which with the bonus depreciation, as maybe we'll speak about, you can literally take that in the first year as a write-off. But again, this is for any type of property except for your personal residence, okay? If it's a business property or if it's an investment property, you can do cost segregation and you get the regular depreciation deductions, which will give you about a 2 to 3% deduction every year. That's kind of how it comes out to be. I see. You're taking off land, which doesn't depreciate, and then whatever's left over a 27.5 or 39-year schedule comes out to be somewhere between 2 and 3%. But you can accelerate that and take in the first year, instead of a 2% deduction, you can take a 20 or 30% deduction. Wow. Which it's just incredible. This is one of the, wealth building strategies that, that people like you and smart investors know about.
Absolutely. I mean, depreciation plays such a huge component and adds to the bottom line that, investors can be like earning real positive cash flow, but for tax paying purposes, depreciation can completely offset that and take it into negative, and you could be reporting in negative, and it's such a powerful tool to avoid taxes and increase your bottom line. So you said, Yonah, you alluded to rather the bonus depreciation, right? Could you maybe help us, like, why it came about, or what sort of benefits are from a bonus depreciation perspective?
Absolutely. So one of the things that happened in the previous tax reform, so we're going back to 2017, 2018, the Tax Cuts and Jobs Act, is they introduced this law called 100% bonus depreciation, as I mentioned, which allows you to, on an acquisition, to literally take all of that accelerated depreciation, instead of spreading it over a 5 or 15-year schedule, instead of 27 or 39, you can accelerate to that, but you can also claim it all in the first year, right? So like I said, instead of a 2% or 3% deduction, you could accelerate that. And the first 5 years, you could take, a 5 or 6 or 7% deduction, which, is a lot more, or you can accelerate it all into year number 1 with bonus depreciation and take, 20, 30% deduction. So those are kind of the numbers, how it usually works. Obviously, single family properties typically have less percentage wise, because if you think about it, if you buy, a 100 unit apartment building, you have 100 kitchens. Okay. It's 100 cabinets. You have 100, sinks and appliances and all those things. There's a lot of value, more value allocated to that than just the walls.
Right.
And,
right.
you know, the square footage of carpeting is much more. Whereas in a single family, you know, you may have, just have one sink, and it's still percentage based. Okay. But it's still going to be less because
Sure. It's all relative based on, how big it is. Now,
Exactly.
the correlation there now, between, let's say, you buy a $10 million portfolio, for example, right? And you take on the first year, you do the cost seg study, and, you take bonus depreciation first year, right? How does that correlate to now, like year 2, year 3, year 4? How does that play into, like, meaning, are they mutually exclusive, or how? Could you maybe help us understand that aspect?
There's really two. There's probably a lot more important things to understand to answer that question. There's two main things to understand to get to that question. The first thing is when you have more deductions than you actually have income, and this is what happens when you do a bonus depreciation most of the time. Okay,
right.
You may have like your $10 million portfolio, right? So what is that making you? Maybe let's be generous and say $1 million net operating income. Okay,
sure.
Very generous. So of that $1 million income, you may have in the first year $2 million, right, or $3 million of tax deductions for the bonus depreciation. What happens to those extra deductions? What happens is it creates what's called a passive loss.
Right.
Okay, you can't use it all right now, unless you're a real estate professional, which maybe we'll get to that in a little bit.
Sure.
But normally, you can just use those depreciation deductions to offset the income from your properties. Okay.
Right.
That's the first thing. It creates this loss, but that loss doesn't disappear. You just can't use it immediately right now. You can use it in future years. So it carries forward with you. So in year number 2, right, you may have another $1 million of income, and you have this regular depreciation, which, you'll still get, because again, we're just front loading, let's say 20%. The rest of the 80% of depreciation is still going to be about 2% every year. So you're still going to get a sizable deduction, but from the regular depreciation left over, and you'll still have another $1 million left over from the passive loss, you can now use that to offset the income this year. So in year 3, okay, so year number 1, year number 2, you're paying 0 taxes, basically, right? If you're doing the bonus. Year number 3, that you still may have some left over, you still have the regular depreciation, you still have some left over from the passive losses, and, so you're going to offset that. If you're doing the bonus depreciation, at that point, it's going to run out and you're just going to have less depreciation after that. However, the second thing you have to understand about this is that cost segregation and depreciation in general applies across all properties, which means if you buy another property next year or 2 years down the line, then you can use the depreciation there to also go and cross multiply, cross pollinate, if you will, on your other properties, on the other income. So you may run, if you're doing the bonus depreciation, you may run out of the depreciation this year, from property A, but you may have enough from property B and get the depreciation there. So this is the way I always say, if you're a one property guy, okay, if you're just buying one property and that's it, and you're planning on holding forever, then cost segregation may not be for you. It may not be the right thing at all. You may just want to keep your depreciation equal and have a business plan kind of that operates with that. Or you might just want to do regular cost segregation and have in the first few years extra tax deductions, which will help with the cash flow and help with, doing improvements. But if you're a multiple property guy and you're buying more than one building, more than one property, then that's when you can really take massive advantage of this.
Sure, it can accelerate. Got it. So now, Yonah, how can new investors get started with you? Meaning, like, what's the process involved? Do they call your office, or what initial information they need to supply to you?
Absolutely. The first thing we always do is we'll run a free estimate. Okay. So we'll look at some details on the building and your property, and we'll ask you for some data about that. And we will tell you based on, we've done thousands over, at this point, our company's done over 16,000 cost segregation studies. So we have enough experience just knowing some data points, your property, what you're going to get. Okay.
Sure.
So doing that, you'll actually know ahead of time, first step, even before I do anything, right? Is this going to be worth it, or is it not going to be worth it?
Right.
You'll know upfront, what the fees, what's going to cost to do that as well. which will charge for the app. So the first step is reach out to myself. You can reach out to me, like I said, business director. So, a lot of stuff flows through me. Anyways, we have a whole operations team. Once we do that, we'll prepare that estimate to you. And you have a conversation, show you, what the benefits are, take this back to your accountant, discuss it, say, does this work for my, my business plan, my strategy? If it works, we will, engage and send an engineer to the property where we'll take those pictures and measurements, et cetera, we'll come back, make a report. And that report, that study is really going to punch out a new depreciation schedule. So it's going to be an updated, broken down into all these different categories.
That's awesome. That's awesome. And I guess one thing I also like about all this is that the whole depreciation clock sort of resets at every ownership. Am I correct?
That's right. You are 100% correct, which is something I always try to touch on because it's so incredible. Depreciation it's not an intrinsic thing. It's not about the actual value of the building going down, which is what the definition of the word means. So if you look up depreciation in a dictionary, you'll see like something going down in value. But the tax deduction of depreciation is just based on that principle.
Right.
And so that exactly right. So you start that over when you buy a property and it's new. So if you bought a property, let's say 10 years ago, right, for $100,000, you're taking depreciation every year. You go ahead and sell that to me this year for $1 million. I now get to start the schedule that 27.5 years over now, day one for me. And I started at $1 million, not at 100,000. So that's what's incredible about this.
Right. No, I love that. And the thing is that, as you, I think, alluded to earlier as well, is that this could as well be the built-in strategy that if you're buying multiple properties, you're continuously taking advantage of the depreciation and perhaps the bonus depreciation as well as you're building the portfolio nice and fast. So awesome. So give us some idea about what sort of are the costs involved in these in all these studies and things like that.
Sure. It's going to be different for every property.
Sure.
So, because it's totally based on the scope of work involved, we have kind of a sliding scale based on the square footage, number of units, type of property, et cetera. Not at all contingent on your tax savings. So if someone's coming in and telling you, I'll do cost segregation for you and I'll take, 5-10% or whatever of your tax savings, I would run like wildfire, because not only is that illegal, but that's horrible. that's going to be really detrimental to your benefits in that. But yeah, it's somewhere between, and again, it's different, but I'd say on the low end, we're charging somewhere from like around $4,000, all the way up to about $10,000, depending on the type of property.
Sure.
Multifamily and residential is usually in the 4 to 6 range. So other type of commercial properties will be more.
Got it. But if it's, let's say, a garden style 80 to 100 unit property, average, let's say 80s or 90s built, brick and siding structure and things like that. So that would be in the $10,000 category, I guess.
No, somewhere around $5,000 to $6,000.
Wow. So that's really inexpensive, but the benefits are big. Exactly,
because it doesn't matter if you are, this 100 unit building you're talking about, you're buying it for $13 million and getting a $4 million tax benefit, to pay $5,000 for that sounds like
it's no brainer. Absolutely. And I know, Yonah, you have a new podcast called Weiss Advice. Yeah. Tell us a little bit about that. I mean, how it came about and what are you looking forward to with the podcast?
It's a great story because I've been a guest on, like I told Sagar before this episode, on close to 100 different podcasts, and this may very well be number 100. I'll do the count afterwards. But in doing that, I got to speak to so many different amazing people in the real estate industry, and I kind of had a lot of fun doing it. Right? I enjoy doing this. I enjoy talking to people and But on the other hand, I don't like to do all the talking. I actually like to ask a lot of questions and have conversations. So figured, hey, this is a great platform to me to go about and do that. And so I talked to real estate owners and just business people in general who are successful, people that I know, some of the most successful people that I know, and learn about life and about, business and about mindset, about goals and, great stuff that really talks to everyone. And I think everyone, no matter where you are in life, can relate to those kind of subjects. And hearing, I ask the questions myself because these are the questions that I want to know for myself.
Absolutely.
And so I think it's great. Like, for example, today I had someone on, and I'm, really interested in, building a list and email marketing and things like that for my own business. Sure. And I know that this person is an extremely successful entrepreneur and has done that because I'm on his list and I get his emails. I know what he's doing. So I just asked him, some advice on how he went about doing that and what are the tools he uses, et cetera. And some advice about going about doing. So things like that, which I think are, really valuable.
Thank you. And I will certainly be looking forward to it and learn more from you as well. Please tell us, Yonah, like how they, viewers can find you and also listen to your podcast. Give us some contact information there.
Absolutely. You can find me on LinkedIn. That's the place I spend most of my time, believe it or not. Weiss Advice. Check it out anywhere you listen to podcasts. We're on all the platforms. So check it out, Weiss Advice, or you can email me directly at yweiss@madisonspecs.com. So that's my email or company if you want a free estimate, something about discuss cost segregation. Happy to do so with anyone. And I appreciate you very much, Dr., for taking the time and having me on your show.
Thank you. You added a lot of value, Yonah. I hope all the listeners can reach out to you for all the needs of depreciation and cost seg. It's been a pleasure having you. And viewers can also listen more to our Premium Cashflow podcast on all the different platforms we air, and also YouTube, Facebook, LinkedIn. We are everywhere. So it's been a pleasure, Yonah. Thank you for coming on.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.